So my plan this morning is to give you a sense for how consumers are changing in the marketplace, how manufacturers are changing, carriers in the marketplace as a result of what they're seeing at the consumer level. I'm going to share with you some research we've done on a large number of advisors like yourself, 1,200 of them who've been in the business 5 to 40 years, successful practices in different kind of practice organizations, and how they're viewing the world around them and making changes. I think my role as a presenter is to both inform and provoke. So I hope you'll feel a little more knowledgeable at the end of the next hour or so, and a little agitated, because I won't have done my job if I haven't done at least a little bit of that. Some Canadian stats, and I'm going to do these very quickly, but this slide shows you only 43% of Canadian households say they own life insurance. Only 50% say they own group insurance. And if you combine them, because you can own one or the other or both, 68% own some kind of life insurance. 32% of Canadian households own no life insurance, individual or group. Largely that's driven by a couple of things. One is that the traditional distribution system has abandoned the middle market. Now, how do they feel about how much they own? 45% of Canadian households would tell you they need more life insurance. And it's unaided by any kind of needs analysis. It's self-declared. And it's got nothing to do with whether what they own is enough or whether they need more. Carriers think, and I heard a very senior executive in a Canadian large life insurance Canadian company say about 2 years ago, they believe that about 20% of the life insurance marketplace is going to go digital. And so they're still extremely committed to the face-to-face distribution system, but nor can they ignore 20% of the marketplace. It would be almost like ignoring Quebec. In the Canadian marketplace, it's 25% of the population. So you're going to see carriers viewing this information and going multiple ways at different kinds of markets. A lot of people assume that this is really skewed toward the younger end of the marketplace, the lower income end of the marketplace, but in fact, it's not true. I just want to give you a sense for this. Look at households with $150,000 or more of income. A quarter of them, more than a quarter of them, still say that they need more life insurance. And what that means is, if you see numbers on the slide, our PhD researchers did them, take them to the bank. If you hear words come out of my mouth, be a little leery, use them at your own risk. But I had the researchers run this at $250,000 or more of household income. And they got exactly the same result. Now, they won't let me put it on the slide because the sample size gets smaller as you get that number up. But there's still a large percentage of relatively well-to-do Canadians who said that they think they need more life insurance. And also look at these numbers. 55 and over, almost 40% say that they need more. So there's a big marketplace for this going forward. So the world around us, the world around you is changing. And I use this slide as a simple example, talking about how consumers want to engage and how we engage with them. 20 years ago, there was strong alignment in our industry with consumers and how they wanted to engage. But in fact, we typically gave them only one model. And that was true of almost anything. If you wanted to buy a new pair of blue jeans, and you bought them from Sears, and you could either go in the store and buy them, or you could order them in the catalog and go in the store and pick them up. One model. But over the last 20 years, the models have changed significantly, largely to virtual and digital. And so now we're seeing that the industries around us have changed way more rapidly than we have. But consumer expectations have changed like those other models. And so there's an engagement gap between what we offer consumers and the way in which they want to be dealt with. And so we're going to talk about that a little bit over the next couple of minutes. So more and more industries in the financial services arena are trying to think about new ways to engage with consumers. And consumers have a lot more options than they used to have. They're clearly the traditional financial professionals. There's stuff going on the internet, there's the workplace, they're still dealing with friends. It makes it really difficult to understand how to connect with them in a way that stays really meaningful for them, because we forget about this from their perspective. And so I'm going to be sharing some information from LIMRA research that will shed some light, I hope, on what's happening in this regard. But I want to quote a really famous Canadian philosopher, Wayne Gretzky. Wayne Gretzky said, "A good hockey player plays where the puck is. A great hockey player plays where the puck is going to be." And my plan is to share with you my opinion of where the financial services puck is going to be over the next 5 to 10. So we asked them what their best sources were for financial information, and this is what they gave us. I'm not particularly surprised, although if we had done this 20 years ago, the internet would have been like 2%. We could do presentations in any one of these categories I'm sharing with you. This is the speed dating version that I showed you, but in fact, that 76% financial professionals, Canadians, 56%, 76% will still tell you that they want to deal face-to-face for making a financial services decision. And that doesn't change very much by age group. So it's not skewed to the older folks versus the younger folks. And the reason is what we do is relatively complicated. One last preliminary slide. I shared with you earlier how I'm using US data as well as Canadian data. This is why. Look at these statistics. We asked Canadians and we asked Americans to rank their top financial concerns. And retirement and healthcare was at the top in both countries. They were just flipped. We surveyed them around life insurance ownership, and you notice they are almost identical. These are the numbers I shared with you earlier around the need for more. By the way, 2013, we're actually fielding that study as we speak. Those numbers will be updated again this year. They don't change that frequently. We only do that research every 4 or 5 years. It's about a $200,000 piece of research. Need more life insurance. The numbers are almost identical. Likely to buy. They're more alike than you think. Having trouble in meeting immediate needs in the event of difficulty in the next 3 months by the loss of income from a breadwinner, be it death, disability, critical illness. A third. If you ask them several months, 2/3 would have said they'd be in difficulty. Future channel preference. I told you there's 76% for Canadians. The American one is almost the same because I think you ought to add worksite and face-to-face because worksite's a much bigger deal in the US. It's just a different version of face-to-face. So I want you to pay as much attention to the US research as the Canadian research, especially where it's attitudinal. The only cautions I give my clients is if it's something driven by the banking system or regulation, there may be differences underneath that we need to be concerned about, but not for purposes like this. So I'm going to now go through those most valued sources and let you know what we see based on our research is changing in the marketplace for those folks. We seem to be at an inflection point on the minds of consumers as it relates to how they want to be served, how they want to acquire information, and the kind of relationship that they want going forward with financial professionals. And it's any kind of financial professionals, but we're also finding it to be true in our industry. People still want to work with an advisor, but there's a distinct blurring of distribution in the advisor world as seen by consumers and as evidenced by their activity. When we serve these folks, 52% said they want to deal with a single financial professional. 37% a single financial professional who can refer me to someone else if the need becomes really evident. And then the last version, 11%, multiple financial professionals. So from your own perspective, the question is, when you're dealing with your clients, how are you presenting yourself in terms of your ability to connect them with an expert where expertise is required? We're no longer working in an environment where they think you need to have all of the answers to all of the questions, but you need to help them get the answers when those things are required. But not only do they want this, in addition to this, they want a digital relationship. In addition to a financial services professional, they want a digital relationship. 73% would like to educate themselves about insurance on your website, but they're also going to carrier websites and other industry websites to gather information. And 67% of them said they wouldn't do business with an advisor that has an out-of-date website. Anybody here have their own website? A few of you? Keep it current? It's a big deal for the growing Canadian population, the growing North American population, because one of the first things we all do now, and I suspect it's everyone in this room, Is Google something? When you're looking for a new product, a new piece of information, it's the first point that folks go to. So you're not going to need to do that with your clients. Consumers are going to go to the internet to look for things that you're doing, or to double check, or to get the breadth of what's out in the marketplace, and you know they are. Give them suggested sites to go to. Give them advisor-friendly sites to go to. Help them do what you already know they're going to do. Don't try to get in the way of it, because then they will always come back to you with answers to their questions, because they know they need advice. It's a complicated world. But the more you help them with that whole process, the better off you will be in dealing with this. And so this is the other piece of research that's really impacting carriers around. They need to stay relevant in a virtual world within consumers, because it's the way the consumer worlds are going. And so I encourage you, as I had said, just to think about how you're engaging with your clients digitally. So I mentioned earlier, we had a piece of research we did. This was in the US with 1,200 advisors. It was done jointly with EY. EY, by the way, is now, it's like print. It's the organization formerly known as Ernst Young. They not just want to be called EY, but we've done a massive piece of research with them, with all of these advisors around how they're reacting to a changing world. And so I'm going to share some of that with you so you think about what's going on in those practices. And these are the highlights of that piece of research. And so I won't read those off. You can read those for yourself. I'm going to keep motoring because this is speed dating. Is anybody here in a multiple advisor practice? Anybody here work regularly with another advisor or two on a kind of consultative way? Anybody thinking about adding an advisor into your practice? Getting a couple of nods on that one. So I'm not going to go deep on this, but there's a new version of this in the industry. And so the old version of bringing people into practices was sort of a mentor relationship. You would recommend someone to the organization you're working with, or you yourself, and you would kind of hold their hand, guide them along. But there's this new terminology that's coming along, and it's associate advisors is adoption of the mentee, and that is truly bringing them into your practice. I can give you a ton of research. It would be a different hour presentation on this around the value of teaming in advisor practices, and how the value to the entire practice goes up in the near term by dealing with clients who you haven't dealt with in a while. 100 years ago, in a different life, I worked for Manulish. Am I allowed to say that in this room? And I did a lot of new business stuff for them, and I created an advisor practice consulting organization. I remember working with a very senior advisor. His name was Chuck, and who had brought a mentee into his practice in those days. And he was sitting in front of a group of people like this once, the head office folks, and someone said, Chuck, they said, do you ever do cold calling anymore? Chuck said, let me tell you what cold calling is. He said, the hardest cold calls I ever have to make is calling someone I sold 10 years ago I haven't spoken to since. That's probably doesn't represent anybody in this room. But a lot of these folks are using that to farm the lower clients in their practice, raising the practice revenue currently, bringing an effective person into their business, and actually raising the value of the practice to that person, because they share the relationships, and when the practice passes on, the value is higher than it was when the person was brought into the business. So there's a lot of stuff around this. What are the advisors looking for in terms of growth, who we talked to in our EY study? And so 53% of them said they're planning to expand number of products over the next sort of 3 to 5 years. And 53% of them said they're planning to expand types of products. When we ask them that in a little more detail, so you get a sense as you think about your practice growth going forward, how are they viewing how this might happen? And we created this 2x2 matrix that describes it. On the left side, those independent advisors who are choosing to work with existing agents, not adding any more advisors in their practice, are looking at either penetrating existing households with a concerted effort to move more fully into the household where they have relationships, or adding more products and bringing those into those households in areas where they have not. And typically they might do that by joining with another advisor, because you know that those households, especially if you're in a high net worth practice, those households are being hit by many other options or suggestions going forward. And oftentimes, expanding practice model is also a protection model to make sure you keep those relationships. On the right side of this, adding new advisors, existing products is merely just more of the same. I'm going to leverage, I'm going to get some economies out of my practice by bringing more people in to do what I'm doing. And the new advisor diversification means bringing someone in who has access to markets that are different than the ones I currently have access to. What are these advisors doing in order to be relevant in this changing marketplace that I described? This slide is interesting from a couple of perspectives, but this one tells you how these advisors are looking at the world around them and what they're going to do in areas that they haven't been doing. I think the top two categories are the, how do I make my practice more effective? How do I get more use out of my time? How do I leverage the value of what I'm currently doing? The bottom ones are, how do I take advantage of a changing marketplace or changing tools to expand my effectiveness with my client base or to get into new clients? And so do not have but want. The category that I think really matters here is this blue line, that is do not have but want. So that is where your significant successful peers are seeing the growth is going to come in their practices going forward. Those are the ones that they're saying technology, modeling tools for life insurance strategies, digital support tools to help. They're even thinking about essentially what big companies are thinking about in terms of database marketing. That is, how can I take real advantage of the information that I have to do a better job? My favorite example that's unrelated to an advisor is that a couple of years ago in the States, a really irate father phoned Walmart, very upset because Walmart started sending prenatal information to his 16-year-old daughter. Yeah. And then the next day, he had to call them back and apologize. See, Walmart knew before he did that he was going to be a grandfather. Exactly. And they knew it by her purchase behavior patterns in the Walmart store. And their data analytics saw that and drove it. And so there's lots of stuff going on. Very briefly, I'm going to give you a sense for what's going on with the internet. And so historically, there have been these versions of online options, and all being driven by InsurTech. You've heard the phrase InsurTech. Maybe you've been to a couple of presentations around InsurTech and how technology is changing consumerism, and how we go to market. So direct consumer is pretty obvious. The direct-to-consumer view for insurance carriers is, I get to control the message and the experience of my customers. But just or even more importantly is, I get access to data. I get access to buying, purchase behavior, etc., and then I can use that to leverage. I think the biggest change in the last 3 years that I've seen among the carriers you do business with is the number of data scientists that they have hired. And they're all looking at how they can dig into this information that they now have and better predict for product design, for marketing approaches, etc., how to use that data. Affinity Direct is essentially the same thing, right? I get to go direct, I get to control the message, I get to collect data, but I get to expand the market. I can trade on someone else's relationships by going to that affinity with organizations. And then there's the E-Brokerage model, which essentially is a lead gen model in different ways. And here are just 3 versions of it: Policy Genius, Select Quote, and Insurance, and they are more in-depth iterations of this. And I was trying to think of this morning and I couldn't. I'll make more the next time I see it. But someone has an ad right now in Canada, and I think it's one of the banks, RBC or BMO, where they talk about, and it's one of these house flipper celebrities who talk about they really like when their advisor uses one of these on their behalf. So it's not as much driven anymore about the consumer using them. It's their expectation that their advisor is going to take advantage of things that they can't or aren't sort of too familiar with. And they do that and expect more of that going forward. Here's a spreadsheet of them. You can Google any of these and find out what's going on in this marketplace. By the way, if anybody wants access to these slides, you can get them through your IDC friends. I'm happy to have you use them. In fact, I encourage sometimes people to use this stuff with your clients as third-party reference. You know, I was just at a seminar, and I heard this fast-talking guy mention this thing about consumers generally, and I was wondering if that's an issue for you or for someone like you who I should be talking to. Anybody ever heard of Teachers Life? Teachers Life is a fraternal organization in Mississauga, Ontario, just outside of Toronto. They have 16 people in their head office, 1/6. They are now a digital company. And they did it by networking with insurtech firms. And so they can go anywhere from collecting clients online to underwriting simplified issue to delivering the policy in a Dropbox. And a company with just 16 people can do that in this day and age. It's become easier. And so consumers are starting to see that stuff. You don't have to do that, but I think you ought to be aware of it. The online enthusiasts aren't who you think they are. This is based on hard LIMRA research, US. The highest profile of an online buyer is a male, age 34. I'm gonna get these. 3 and 4 are married. 2 out of 3 have children. Here's where it starts to get different though. They're 4 times as likely to say that they are upper class or wealthy compared to their peers. 4 times. They are 4 times as likely to say they're very knowledgeable at finances than their peers. They're 2 times as likely to have a financial professional. 4 and 5 already own life insurance. 2 and 3 already own individual life insurance. You see, they're your clients, or they're the children of your clients. And they're the most likely online enthusiasts because you've enabled them. They feel confident, and they're living in a world that's changing around them. And so the world is changing with regard to these folks, and it's going to change going forward, and I just think it's something you ought to keep in mind. Our Robo-Advisors, I'm going to do only a second on this because I'm a little concerned about time. There are varying models for robo-advice, and we talked earlier about I think it's RBC that essentially talks about robo-advisors, but they don't use those phrases. What we're finding is that there's very, very little familiarity about robo-advisors on the minds of the consumers in our industry. If we were sitting in a room here 10 years ago, we would have been very worried about robo as it relates to the work that you do, and that's just not the case anymore. And not only that, all of our research says that consumers largely aren't interested in robo for the most part. Exception being the line I said earlier, and that is, I don't mind if my advisor uses robo to help him or her in deal with me. It's kind of like a multiple advisor practice. It's just with artificial intelligence, but it's not for me personally. Workplace. I got some stats here on the workplace, and there's one piece that I particularly want to share with you, and I'm going to fast forward to it. But in the US, I said worksite marketing is a big deal. It's not in Canada for a variety of reasons. But I think there are some things going on in the workplace world that are changing perception. And it would be useful for you to have some knowledge about that in order to have conversations with consumers. And here's one. Look at how in 1994, and this is US numbers, but the Canadian numbers are almost identical. The only difference, labor force difference, other than ethnicity, in our 2 countries is there was like a 3 or 4 year gap in the baby boom. And the reason was Canadians stayed longer to do cleanup, if you will, in Europe than the Americans did. So our soldiers didn't return home quite as quickly. And as a result, our boom was about 2 or 3 years later than the US boom. Look at how this marketplace has changed in a relatively small amount of time. Now, what's interesting is we are still of the mindset that says boomers were the pig and the python. We all remember those videos, right, about moving through. But the fact is, if you took millennials and baby boomers between the ages of like 30 and 50, there are just as many of them as there are boomers, or were boomers. There are just as many people in that prime life insurance age buying category as the pig and the python. We just don't think about them that way because our mindset is still on all the old gray-haired folks like me who are still kicking around. The workplace is changing, and I'm sure you all know this, but it's interesting. One of the things to read about it, 82% of people are full-time employees, 18% are part-time, and 5% prime age workers have multiple jobs. It used to be, in our parents' time, you got hired by a company, you worked there for 45 years, you retired at the age of 65, you died when you were 67. That's why 65 is the retirement age. These days, that model just doesn't exist anymore. We're clearly in a model where my allegiance is to my craft, not to my company. If I'm a marketer, if I'm an IT person, whatever it is, I'm going to change companies every 5 to 7 years, but I'm probably going to stay within my craft. So that's changing the way in which consumers think about the longevity of caring for themselves in their financial well-being going forward. But the other thing that's emerging now is something called the gig economy. Anybody ever heard the phrase the gig economy? Yeah. The gig economy is a growing number of consumers, workers in North America, who in fact are moving from job to job on an as-needed basis. I periodically get calls from people saying, I'm between assignments, meaning careers, but every once in a while someone says, you know, I'm kind of liking this. I'm a little older now. I'm not financially dependent as much as I was on my income, but I still want to work. I'm going to move from gig to gig. And there are a growing number of people doing that. And this slide talks about percentages of people now earning money in a variety of activities that are non-traditional. And so I think you need to think about that. For not only because they're maybe your clients, but as you're advising your clients about their children, the ability to speak their language is really meaningful. I also think, by the way, that different presentation, but all that money that's going to transfer assets between the people who have it and the people who are going to inherit it, it's on wheels. The money's not going to follow the parent. The money's going to follow whoever the inheritor has the relationship with. So if you haven't thought about doing something in your practice, it may be adopting a younger advisor, whatever it is. It may just be learning to speak. It may be appearing relevant by using multiple digital ways to stay connected. Will help you keep control of that money. That's going to move forward. So this is a slide of Canadian opportunity in the life insurance industry based on some work that we've done over time. And I put it in here just because I want you to think about 3 categories of information. If all of those people who told us they need more, or those people who said, I'm going to get this close to right, Canadians now own on average 2.8 times income in life insurance, those who own. And females own a little less than males do. And so if we use any rule of thumb like 7 times or whatever, they're quite underinsured, even those who own. And then there are all those who don't own, who unaided, we've said, how much do you think you ought to have? And they would say something like 3 times income. If they acted on that, we'd sell $1.6 trillion of life insurance. Now, it's premium, it's not commission, but do the math. It's a pretty sizable amount of money. There's a big marketplace. And it's not very skewed, as I showed you in that one earlier slide. The other two things that I think I want you to pay attention to here is upper right-hand corner. About 1 in 4 middle and high income households say they might buy life insurance in the next 12 months. Quarter of high income Canadian households say that they might buy life insurance in the next 12 months. And the other one is this middle bubble. Half of those likely to buy in the next year are stalling because they don't know how much, they don't know what to buy, they don't know enough about life insurance, or they worry about making the wrong decision. We created another presentation, another hour, another day. We created a pictorial about the decision-making process for life insurance that North Americans make. And it starts with, I know I need more. What am I going to do about it? I'm going to Google it. I Google everything when I think I don't know something and I want to find out more information. And I'm going to gather some information. We did some research a few years ago that said, how did you feel about, how was your knowledge about life insurance after you met with your advisor for the first time? Not a new advisor in the business, your advisor for the first time. 63% of them said, I left more confused than when I arrived. So you own that. Maybe not you in this room, but so we're all participating. I Google it, I get some information. I then want to look for an advisor because I really need help in this. And then when I find an advisor I can trust, I want the advisor to do two things. This is a subtle but big deal, two things. I want the advisor to answer my questions. I want the advisor to ask me questions that I wasn't smart enough to ask for myself. I want them to protect me from what I don't know and from what I should be considering. That whole part about worrying about making the wrong decision. If I buy a toast and it's the wrong decision, it's no big deal. If I buy one of your products and it's the wrong decision, it's a really big deal.